Welcome to the Stock Group. Today is Saturday, February 19th. And let's look at the market. But before, we had a question. How are we doing in the market? And so I started by saying I'm getting killed. And I'll show you why. So this is the Dow Jones, right? So let's go back. So the Dow has performed. So this is like January, right? So you can see here, the Dow decreased a lot in January, rebounded from January 24th, got back up to a decent level February 22nd, and then down again, right? So that's the Dow. But I want you to concentrate on this November time frame. So look here. Going back to November. So from November to December, the Dow took a dive, and let's just measure some of that out. And this is good. So, all right. So it took a dive. It was down 6%. Then again, it rose back up above that, recovered that 7% or so, got back up back here to whatever this was in, what's that? January 4th. So from January 4th to February 2nd, the Dow was down, and then it recovered again. And then on this last one, down, recovered that, about half of that, and then down again 5%. So that's the Dow. So the Dow actually fared better. So I'm gonna just jump to the Russell. So again, the Dow is Dow Industrial Stocks, 30 industrials. They got a few tech companies in there, but it's not tech heavily focused, right? But if you go to the Russell is small cap. So small caps are so capitalization again is the a company's shares times the times the price. So that's all. It's called market cap. So you take the price of a share of a particular company, and then you multiply that times the number of outstanding shares. And then that's a way to size a company. So the Russell concentrates on companies in small cap. Small cap is a company from 300 million to 2 billion. So that's considered a small cap stock. So you can see here from November all the way down to January, this was pretty much just down. So you see this first leg here down, and then from January 4th, it took more of an aggressive slope down. And so you can see here that we went down even more. So that's the Russell. So this where the Dow kind of yo-yoed up and down a few times from what we saw here and what I showed 1, 2, 3, the Russell was pretty much straight down, had a little bit sideways movement here from December to January 4th, but then January 4th, was straight down. So if you measure those two descents, so you say from here to here was 12%, and then from here down below to where we are now, it's another 11%. So you're talking 20% down. And anytime you get into a 20% down move in an index is referred to as a market is in a bear market. So the Russell is actually in a bear market. Now, when you go to the Nasdaq was a little bit similar to the Russell, but you can see it didn't go straight down. The Nasdaq kind of went down first time to December, went back up a little bit, touched again December 21st, came back up, and then you can see this real pullback is when the Nasdaq started going down January 4th. So if you look back at January 4th, so if we go here, January 4th, this was a high in the Dow. January 4th, you got not quite a high, but a secondary high here in the Nasdaq stocks, and Nasdaq is tech related stocks. But you see the Russell here, January 4th. So at this point, all the indices kind of start going down together from January 4th. And so for the Russell, it peaked to the downside on the 28th, and then it reversed. let's see here. This is the 24th. It reversed, and then it came back and touched again on the 28th for the Nasdaq, and then the Russell is a 28th here as well. So if you look at this portion here, all the indices pretty much went down during this time, whereas you already had this first leg move down on the Russell as well as the Nasdaq. And if you look at the S&P 500, so this is again industrials, tech stocks, small cap stocks, but then the S&P 500 is really you can think of this almost as a composite of these three kind of together. It's not exactly, but a lot of times people just look at this one S&P 500 as an index that represents everything. So if you look at this here and you say, okay, so they were down, let's measure that. So again, going back to that November, so you can see here is a little bit different. So we go back to that November 8th or whatever. So you can see here on the Nasdaq, the S&P, it just went kind of sideways. And actually they had a run up from December 23rd to January 4th. But you can see this January 4th to that January 24th, January 28th, it went down as well. So pretty much anything that you've held since January 4th to now is going to be down. Now, these are just the indices and they're down, but there has been an extreme amount of volatility in the market, since December, which we've seen in each of these indexes. So that's really the backdrop of the broader market. And because of that, the individual stocks that you own, they're gonna track according to those, because again, an index is nothing more than a collection or a group of stocks, but based upon what that particular group identifies or categorizes themselves as, right? So Apple is actually in the Dow, Apple is in the Nasdaq, right? So when Apple is down, it's going to affect these two indices, right? Like say a small cap. So like APPS, that's a small cap stock. It's going to be affected when the Russell is down. So in that, when you start looking at individual names, you'll start seeing them being down as well. So again, going back to the question, yeah, most people are down from January 4th. And if you're in Russell related stocks, small cap stocks, and so I'll show you one. Let's look at this ABQ. So we knew that the Russell was getting killed from November, right? So look, November 3rd, look at how much this stock is down from November 3rd, just on a percentage basis, 66% down. That's November 3rd. You look at the Kathy Woods funds, go back to November 3rd, 4th, anywhere. November, down 47%. All right. Let's look at another. Let's look at another small cap stock. All right, look at Chewy. Chewy is the dog food company, right? Let's go November 2nd, right? So from November 2nd to where we are today, down 45%. CLSK, Bitcoin and alternative energy stock, down 75%, but got a nice little run here recently. So if you take a back up here, so it's up a little bit from here, from that down. So if you just measured from where we are then to where we are today, so you're talking 62%. So anybody else want to kind of comment on their individual, what their portfolio is looking like since, say, November till today? I'm getting killed, so.
I'm also did this in the same situation. I just put most of my portfolio is with the ARK.
Okay. Now, I would say this. I think, so to me, the boogeyman, let me let the rest of the people answer. I know David said you're not in the market right now. What about you, Angela?
Well, remember when I told you that I had sold a lot of stocks when I started seeing it go down?
Mhm.
And as I've been watching it, I haven't felt like I wanted to even load up on anything because it's still going down. So yeah, I'm just watching it right now.
Okay. Brenda?
What was the question, Mike?
I was saying, how's your portfolio been performing say the last 2 or 3 months, and what are you doing?
Okay, so beginning of the year, yeah, I took a heavy dive, but I was okay with that. And so I'm pretty stable now, but I've been balancing out with some of the gold and silver is bouncing for me now. And so that's kind of stabilizing me quite a bit.
Okay, good. All right. Dick, how about you? El Lorenzo.
Yeah, I'm pretty much ditto with the group. I've been hurt also, man. I'm just sitting on the sideline right now.
Okay. Have you picked up anything?
Nah, not a thing. I'm just sitting around looking right now.
Okay. Yeah, and I know Andre is he's in Fubo with me, so we've been trading this Fubo, and this is one we got killed on, but we're using some options to try to fight back. But you can see here, Fubo, 75% down. So it's been brutal. Now, so go back to the other comment I was going to make. So one of the things where the market has just been, so let's just look at the Nasdaq. So you can see these bars. So these bars represents a day, right? So you can see here, up one day, pretty good. Up, so you got 3 days up, 2 days down, a day up, a day down, a day up, 2 days up, 2 days down, 2 days, 3 days up, 2 days down. So you can just see we just been yo-yoing back and forth in this area. Now for traders, for those of you that trade kind of in and out, you can take advantage of these of this up and down, up 2 days, down 3 days, or vice versa, right, or whatever, because this is volatility in the market. So you can see. So let's look at a name specifically. I'm trying to find. You know what? I'll just show you one that I'll just show it just for the sake of again, just showing up and down. So forget these 3 bars here because they came out with earnings, and so I'll just move that out the way. But if you just look here, you can see here, up 2 days, down 2 days, up 3 days, big, down 4 days, up 2 days, down 2 days, up 2 days, right? So it's just been a real choppy market back and forth. Now, I tend to think that, like we talked about last week, and, kind of what do we know? Let me see here. Yeah, what do we know? Interest rates will increase. Stocks have corrected. Inflation is increasing. We got crisis in Russia, Ukraine, and they rotated out of the high PE stocks to the lower PE stocks. So let's go to that. I want to show you something there, and then I'm gonna go back to the interest rate conversation. So we talked about this a little bit last week. So when I showed you all back in November. So back in November, so look here. So on those other charts I was showing in November, we were kind of at a high in the small cap stocks. But so small cap stocks typically are growth related stocks. Growth related stocks usually have a higher PE ratio than value stocks. Value stocks have lower PE. So Apple is a little bit of a hybrid. Apple is still growing. It can be considered somewhat of a growth stock, but it has a low PE. And so you can see here from November, I think it was like November 4th, November 8th, Apple actually went up from November 10th all the way to right here, December 13th, had a little bit of pullback and went up again. Now everything got caught from January January 4th to 28th of January. So everything was down. Really didn't matter what you held. But this correction here, well, this piece here was the rotation out of small caps into value related stocks. And so that, that just happened, right? And again, I think it was spooked by some of the inflation talk and all of that. And inflation really got started talking and really drove the market down. And then Timothy Powell, the Fed chairman, started talking about raising interest rates, and that just killed the market. And we're still kind of stuck in that, because the thing is, all he has done is just talk. They actually hasn't raised the interest rate yet. So there's a meeting. So I think I forget the number of times the Fed meets, but I think it's either quarterly or every other month. I don't know exactly, but I know in March they are going to meet in March, and the idea is that they're going to raise the interest rates in March. So for higher growth stocks, what that means is that the cost to obtain goods and services is going to be more expensive, because credit now is higher because the interest rates have went up. So therefore, they on growth stocks, it costs them more to do business. And so it's really like this idea where when you're in what they call a risk on environment, you take on more risky environments because they offer a higher potential of return. But in times of uncertainty, you move more toward value-based stocks and stocks that are more consistent and stable. And that's kind of characterized again by the low PE. So this Fed conversation is going to affect the interest rates. And because of that, the market is unsure. So there was talk about that there was going to be like a 25 basis point raise. And so if you ever hear when they say basis point, that just means interest rates are priced in percentages, right? So when they say a basis point is nothing but, like I say, 25 basis points. That's 0.25 of 1%, right? So if they say 100 basis points, that's 100%. If they say 25 basis point, that's 25% of 1%, right? So 0.25 versus a percent would be just 1.0. So in that, they're talking about doing a quarter of a point, and that was their original talk. But here recently, there's been talk that the Fed is actually going to raise the interest rates a quarter of a point. So if you have credit card debt, typically your credit card debt is priced in what they call prime rate plus a certain amount on top of prime. So prime right now is probably, 0.025 maybe. And so if they add another 0.25 by raising that up, or even go a quarter a point, then that's going to increase to 0.75 if they do 50 basis points, if you're starting out at 0.25 right now, versus if they just add another quarter of a point, then it'll go to 50. So that means that whatever credit card debt that you may have, then that's gonna increase your interest rate up, because it follows whatever the Fed rate is. If you have a adjustable rate mortgage, that's going to increase as well. Now, some of the adjustable rate mortgages have a cap in them where they say, hey, as long as it doesn't go above a certain rate, then you're kind of protected. But sometimes the incremental rates can be affected. So it's just basically the cost of money is going to go up, and as a result of that, the market can't really determine this uncertainty around how the Fed is going to act. So therefore, you got this volatility that we've been seeing in the market. So what I'm hoping for is, I just want the Fed just to go ahead, do whatever they're going to do. Let's do it and get it done. And at least so the market. So I really want a 50 basis point rise in the rate when they meet in March. So we can just go ahead and get that out of the way and try to get some stability back into the market. Because one of the things the market, it does well when it has an outlook about how things are stable. But when something shocks the market, then it gets skittish, and the volatility rises. So so when they talk about the volatility, there's an index called the VIX, and it basically measures the volatility ratio. So a low volatility environment is where the VIX is down in the, say, 10 or 11, or even 9. So this is a low volatility environment when the VIX is this low. I'm trying to draw it. So yeah, so if the VIX is down here, it's low, but you can see here, you say anywhere from an 8 to a 12, but you can see we've been as high as, and just look at where this corresponds. Let's go back in March. That VIX went up to 87. Now it's pulled back, but it's still at where we at now, 27. So when you say in context to where we are, we're double what we are normally on the VIX from a low volatility environment to a higher volatility. And where this makes a difference is that when this increases, that's where we saw a lot of the interest rate stuff. I mean, I'm sorry, not interest rate, but just a lot of the volatility coming to market. So if you go here 2020, you can see here. So this is November. We were around in the 15 area. November, you see we jumped up. November, December, we jumped up to 34, pulled back, and then January 13th, from the 13th through the 24th, we went up almost double, and then we came back down. And so right now we're, still elevated at this 20 something level. So I think once the Fed announces that, we should get a pullback in the VIX, because now the market can price that in. And then, but they're still going to be monitoring like the inflation news, CPI numbers, GDP, and all that stuff. That's the thing that the Fed looks at in order to try to determine, because one of the things that is that, so inflation, gas prices are higher, food prices are higher, rents are increased, housing prices are going crazy. And so I was actually watching the news yesterday, and they were talking about in Atlanta, they were in Buckhead or Midtown somewhere. They were saying that rent increases were going up, $200 and $300 a month for some people when they reset for the next when their not mortgage, but when their lease runs out and they have to sign a new lease. They're looking at anywhere from $100 to probably $300 increase in rents. And so they were interviewing. It was like, one lady was saying, it's like, hey, but we're not getting wage increases to that degree. So they're going to be squeezed in terms of how much more they have to pay to live. So that's where this inflation stuff kind of comes in. So you think about that, you think about the cost of food, and in some parts of the country, gas is going crazy as well. So those are all factors of rising prices, which is what inflation is. So I'll pause there. I talked a lot. Any questions? Any feedback on that? Or even, are you all seeing that in, as you go about your daily business, this rate increases on, just the cost of things that you normally buy?
Just to follow up on what you said about Atlanta, yeah, my daughter was just looking to leave out of her place and rent another place, and she was saying how just between the year, what would have cost her $1,400-$1,600 before, now into the 22s, 23s, and
wow,
they've been debating on whether or not just to buy, because like that's a mortgage, but then they don't want to be caught in the high home prices right now and then be upside down in a couple of years. And so, yeah, it's pretty ugly up there right now.
Yeah.
Even coming side also same, Mike, when actually I took this, that in November, the other guy who is staying in the same apartment, he's paying around $1,400 to $1,500. Now I'm paying $1,800 actually.
Wow. Yeah. It's crazy. These prices are just really going up, and particularly on the housing stuff, they said that it doesn't look like it's going to be any end in sight, because from what I've heard is that there's still just in terms of single family homes, there's just a shortage. And here's another thing to do as you just drive around, just going about your normal business. So wherever you all stay in the country, how many new apartment complexes have you all seen being constructed, say in the last year? So just as you go to and from work or wherever you're driving, are you seeing new apartment complexes?
Mike, where I'm in Birmingham, I see a lot.
Okay.
I think it's more because people are migrating back into the city here for some strange reason.
Okay. So a lot in Birmingham. I'm in Swanee, Georgia, so I see a lot. There's I can probably think about 3 to 4. No. I'm just kind of scanning through my mind. I can point out 5 that have probably gone up in the last year, 2 years. Apartment complexes.
I can definitely say that I have seen in 2 definite areas. I saw, and I didn't think anything about it. I just happened to see them going up. Mm-hmm. At least 2 different areas. Yep. I'm in Ohio, like the Cleveland area.
Yes, ma'am. Yep. And so we're seeing this because again, if there's not enough single family homes, then people are going to apartments. But the real estate owners, landlords, they recognize this and they're taking advantage of these increased housing prices. It's crazy. So, but that is an effect of inflation, for sure. And this food is crazy, so just even, I remember just going, I don't know, it's probably maybe 5-6 months ago, went to Burger King and I just got a Whopper meal. I think it was like $9. I was like, for a Whopper, a fry and a drink, $9. It's crazy. So, we're feeling it, in a lot of different areas. So, and I just bought some trash bags. A box of 100 trash bags was $19. I couldn't believe that. $19.
Wow. Bacon, $10.
Yeah. So yeah. Bacon is crazy.
It's funny.
And even at that, I'm sorry, go ahead, Milk.
I was saying it's funny. My wife brought some bacon to me. We were at the grocery store. I said, that's too expensive. She said, it's only $5. I looked at it. It was 2.75 ounces. I go, what the crap just happened here?
Yeah. So my wife and my mom, they like this. Was it? Man, I just had the label name in my mind. But they make this thick bacon and it come in probably, I don't know, maybe 20 pieces in it. It's not Wilkes, but Williamson Wilkes or something like that. I can't remember the label. That bacon, it normally would be like $8 or something. That stuff is like, I think $12, $13 now. I mean, it's crazy. So so we're seeing it in a lot of different areas. And toilet paper is crazy. You buy some good toilet paper, some Charmin or some I forget the other brand, but you might pay $20 for some darn toilet paper. It's like, dude, this is literally like one use and throw away. You know what I'm saying? It's like it's just crazy. That's the closest thing to burning up money, it seems like. But anyway, so we're just saying that this this inflation is real. And when wages are not increasing to the same degree, now people are getting squeezed in their budgets, so that's really going to affect. And then just over the pandemic, a lot of pantries and food, I guess, food banks.
The stuff on the floor, bed is a little messy.
Yeah. And food banks, they've been seeing an increase in the number of people, that are food challenged, that, don't have enough to eat. And I mean, it's crazy. So this inflation is out of control. So the thing is that, kind of coming back to the market pieces here is that I want them to get this Fed raise out of the way, at least this first one. And so they're talking about doing 3 to 4 this year. So even if they went with a quarter point for 4 different ones, you're talking about a 1 point increase. If that's 50 basis points per, then you're talking about 2%. So, so it's going to be interesting to see what happens in that. But again, I just want to get this first one out of the way so we can get some stability here. So let's look at some of these names. Apple. So you can see Apple, see they had that run, had to pull back, rebounded a bit. And then now right here at support at the 168. And then next level support is probably, let me draw this one here, is 158. And then from there, 145. So it's Apple. Now, one of the things is talking about just some of these stocks. Some of these are really good companies, but they've been treated like, they're going out of business in some cases. So this is Autodesk. Autodesk is a CAD software provider. They do a lot of business. Is a multi mega cap stock, and so you can see here they've pulled back pretty hard. They're down 36%. So well, actually, it's not even that bad considering some of the other names that are down much worse. Let's look at this is American Tower. American Tower is a cell phone tower company. So it's 2 of the bigger ones, AMT, and another one is SBAC. Those are like the 2 biggest cell tower companies in America. And you can see here they're down about 20%. So not too bad there. This actually, so if you got anything down 20-30% alone, that's actually not bad compared to when you look at some of the small caps. Let's look at Boeing. Boeing has been interesting. You can see really Boeing has really just been in this range going back, from what is that? September to February, been in this range from 128 to 187. So, and we're right smack dab in the middle of that range now. So that's Boeing. Let's look at another large cap stock. So here's an example of a large cap stock that is a value-based stock. This is Caterpillar. So you can see Caterpillar is only down from the highs, only down 16%. So that's good. Where what we were just looking at were 30% and more in some of the other bigger stock names. Here's Costco. Costco pulled back pretty hard from this January 4th to February 24th. January 4th to January 24th. So it was down 17%, but you can see they've rebounded back and they're up 7% off of those lows. So only down 10%. So they actually haven't lost that much money at all. So that's actually pretty good on Costco. John Deere, this is a tractor company. So you can see they've been actually going up in this since December. So you can see here they're actually higher, but they hit a high back, what is this, just February 11th, and they're only down 8% off of their highs. So this is where you can see a benefit. Now, one of the things I haven't talked about is when you have a rotation out of growth into value, and then particularly that coupled with inflation, what you will see is a rotation into what they call hard assets or commodities, right? So when you think about John Deere is a tractor company. So they, farming equipment, all that kind of stuff. And so that's really grain. So wheat, oil, what other commodities? Gold, silver. So, hard goods, real estate, wood, those types of things, probably milk and coffee, soybeans and orange juice. All of those things are probably doing better. So what happens is in those environments, when you have increased inflation, hard assets like that become much more valuable. So, and you can see it's reflected in John Deere here. Let's look at something else. Look at Ford. Ford is really just going through some hard times. They had a decent run here, but they were coming off some of the historic lows off of the pandemic. So if we go back, pandemic, I think, Ford was at $4. So, hit a high 25 here in January and pull back. So that's Ford. Let's see another big cap. If you got any names you want me to look at, I'll pull those up. Home Depot.
Newmont
Mining. Oh, that's a good one. Yeah, Newmont. Yeah. So in terms of the mining companies, yeah, this has been a winner, and you can see this is definitely a rotation into the commodities. And Newmont is a gold miner. Let me see, Newmont. What's some of the other ones, Brand? I don't follow miners that much. Let's FXC, Freeport McMoRan. This is a copper miner, copper producer. You can see here they're toward the highs. So one of the things is as the market shifts based upon certain things, so we see the rotation out of some types of companies and then rotation into others. So just be mindful of that. So we're in this risk off environment and inflation increasing. So these commodity stocks are gonna do better. Let me see if let's look at some oil. Let's look at Marathon Oil. So gas prices are up now. So I know, we talk about some of these things, and then what I want you all to do is start to think about. So we just said that the commodities are rising, right? So in this example, we're saying that oil is going up. So let me ask this question. What I want you to, if I'm gonna ask a general question, then I'm gonna ask a specific one. So when you have commodity prices rising, think about companies that use those commodity stocks. And if those prices are rising, that means it's going to cost that company that used those things more money. So who will be hurt possibly because of the rising cost of commodities? Just kind of as a general question. Then I'm going to ask one pretty specific as it relates here to oil. So you can see Marathon Oil is increasing, right? So which industries depend a lot on oil? Should be one that's pretty apparent. I want y'all to think.
Well, the car company, right?
Yeah, a car company would, but I'm thinking of another industry though. Say it again. I'm sorry, go ahead and say it again, David. I didn't hear the rest of the comment.
The consumer?
The consumer? Yeah, well, yes. But think about a specific industry. All right. So look at this. Airlines, jet fuel. All right. So now as the cost of commodities come up, they're going to have to pay more. Now, they look like they're getting a bounce just because of other macro thing. They're just trying to get more flights in the air. But if we were in a normal environment and we wasn't coming off of these pandemic trying to rebound, airlines would be getting hurt on higher oil prices because jet fuel uses oil as a basis. And so that's a huge cost into their pricing model. So airlines will get hurt, cruise ships will get hurt, but again, they're coming off of just trying to get back in the air, get back on the waters. So they're actually seeing a bump, but in a normal environment, those things will cost them more. Let me see. Trying to think of a natural gas producer. Chesapeake.
Energy transfer.
Energy transfer. All right.
Yes.
Okay. Yeah. So you can see here, energy transfer. So energy is going up, and I know Milton has pointed this out as well. So you can think of energy again as natural gas, oil. Those are commodities, and they're benefiting from this increased inflation. And then there's some ETFs out here too. So my son-in-law told me about this ETF. It's called Gush. So it's a gas and exploration ETF. And so you can see their prices are increasing there. So you can look at some of these commodities companies as well to see if that's something that you want to add to your portfolio, or at least just be aware that in higher interest rate environments that you're going to see an increase in these commodity related companies. Let me see. I'm trying to think of another one. Let me see. APA, Apache. Yeah. Apache I think it's an oil. Yeah. So let's look at Chevron, CVX. Yeah, Chevron. Yep. See Chevron's doing well here. See, is Phillips still? Yeah, Phillips 66. Oil company. Yep. Standard Oil. Used to be called Standard Oil. I don't know. Maybe they're not around anymore. But yeah. So that's it on the commodities pieces. Let's see. Oh, and also with that, you got to look at too this whole idea of the Russia and Ukraine crisis, right? So if in the event that Russia actually declares war and enters into Ukraine, there's a lot of oil that is in that particular region of the world. And if there's a supply disruption, that can cause oil to even spike higher, because if some of the supply lines are cut, then they may not be able to get oil out into certain places, and that may drive up the demand, particularly if some of the oil producers are hurt as a result of that as well. So let's see. So I'll just pause there. Any other questions before we look at some other names?
Gush. All of it.
Yeah, come on. You got something?
I'm just trying to understand about ARK. Actually, that is where I had a bad hit on the ARK.
Yeah. So one of the things, Kamal, right now. So, and this goes for ARK specifically, but this is going to relate to any high growth stocks. So all high growth stocks right now is just not in favor in the market. So the thing is, yeah, I know you're hurting right now, but I believe that innovation is going to win. Think about it. It's just technology in general. So a lot of these companies in the innovative space, that they are technological solutions. So typically technology is instituted to be able to improve efficiencies of a company, right? So when you put technology in, you buy a technological product or service, usually you're going to try to get some cost savings in order for buying that. And overall, we know that. So again, kind of going back to what we know, employment is high, right? You got a labor shortage and a number of workers. So these companies are going to have to spend on technology, because they're going to have to put different things in place to make up for some of the physical labor that they may be missing in terms of bodies. And so even though right now we're just in this high interest rate environment, now it can take a while, don't get me wrong, it can take a while and you're hurting here. But if you take the long-term approach, and if you have good companies, I believe that they're going to come back. It's just out of favor right now. And until this growth stuff comes back, it's going to be down. So what I would say is, if you still, either one or two things, you stop buying some of this growth related stuff and you rotate to more of the value and commodities until this stuff kind of works itself out. But if you're still committed to the growth, you just use this as a long-term opportunity to buy the stuff at lower prices. Now, can it go lower? Yes, it can. So you have to have the stomach and the fortitude to kind of last through that. So if you don't, and this is where your personal psychology comes into play. If you just can't, weather the storm of these losses, and you see your account down at levels that you wouldn't have imagined, it might be too painful for you to keep buying at this level. So I've heard, a couple of you all say that you all are just sitting on the sidelines, just waiting for, the environment to clear up before you start adding to your positions. And that's a strategy. That's absolutely a strategy. So, you have to ask yourself, the way that your mindset is, whatever your risk tolerances are, do you have enough resolve to buy lower in this environment? Or would it, if you can't sleep at night, it's making your stomach hurt, then you might need to be on the sidelines, or you might need to rotate into something else, right? But if you say, hey, I'm going to take a long-term approach, I've been through enough of these cycles, I know that, these things are going to rebound, and I believe I'm picking this up. Just think of it like this. Hey, it's on sale. A bunch of this stuff is on sale now, for sure. It's just a matter of how long it's going to take before it's priced properly and you to get your return from it. But can it go lower? It can go lower. So, this is where when we're in a bull market and everything's going up, investing is easy, trading is easy. But this is really where we find out who we are, is in these down environments, because your fear and your greed, they show themselves in these extreme times. So I tell everybody, try to trade and invest according to your demeanor. That's going to make a big difference in terms of, how much comfort or how much discomfort you have during environments like this.
Got it, Mike.
Yep. For me, like I told you, I'll show you some of the crap I'm getting killed in. So, Chewy, I own this. I'm down big. Actually, I made a trade on CLSK. I made some money on this one. I sold it a couple days ago. I was trading that one. Let me see another one I'm getting killed on. Let's see. Oh, I'll give you one of my biggest ones that they took me out back and shot me. Is NNDM. Getting killed on this one. So you can see it's down. And then probably the biggest one I'm down on is Fubo. So I'm down on Fubo, but I think Fubo it's a streaming company for sports. They're expanding markets. They're opening up new products. And so they're just getting killed right now. But I have resolve to just keep, buying lower, using options to kind of sell premium against it for my shares. And so I'm still fighting in this one. So I have some resolve around this. But if somebody did not have the resolve in this, you may just have to sell it and either go to the sideline or buy something different that is closer to where we are in this economic cycle, because you may not be able to stomach a loss of, you might not be able to stomach a 70, 75% loss. Right. So again, those are individual decisions that you have to make. There's another one, Robinhood came to market at $35, right? Robinhood is now $11.81, right? It's almost 66% down, right? So 2/3. Versus you look at an IBM. IBM hit a low back in here in November, hit a high in January 5th, and now they're in the middle of the range at 124, right? So this is a difference between being in a chart that looks like that and you can't stomach it till you go to something that doesn't really have that much of a pullback. Because even though this looks extreme, you're only talking, what's that? $12. So if you measure that out, $12 off the, from this high right here down, you're only talking down 10%. I love to be down just 10% in some of the stuff that I have, where you see a couple things down, 75%. But taking a long-term view. Now, I don't, and again, I'm just showing this as examples, but some of you are holding some of these things. And again, you have to figure out, how you're going to play it, if it's causing you, stress, and what your thesis is. You got a long-term thesis, or you just trading, or what have you. Is interesting here. I actually read this report. So Roku came out with earnings on, what was that? It's the day of the 19th. So that was Thursday. So they got hurt. Must came out after hours. Roku got killed. This was a $400 stock, probably within the last, it's a $400 and almost $500 stock back in July. Now it's $100. What is that? I just had it. $112, right? So, and I'm interested in this. I actually read the earnings transcript yesterday, and so I think, and then too, you can see here they got killed in terms of volume, but you can look at this volume here. Let's see how far you have to go back. You got to go all the way back to when the stock was $132 back in February of 20. So right before the pandemic, right? Do you see volume of that magnitude to where you see it today? So Roku is definitely interesting. And I'll just give a little bit tidbit, because I read it yesterday in the earnings report. The company executive said that, so think about this. How many of you use have a streaming service and you don't use cable or satellite?
That'd be me.
Okay, that's one. I use YouTube TV. Who still? Well, let me ask it probably an easy way. Who still uses cable or satellite?
My mom does here, but in my household or out on the farm, we definitely we stream. But okay. Here mom's the satellite kind of gal.
Yeah, and you'll get that with some of the older people. They just not really ready to make the jump to streaming. But I and the reason why I asked the question is because what the Roku guys were saying yesterday is that there's only, like, I think they said less than 20% penetration of people cutting cords, and cutting the cord meaning leaving satellite and leaving cable to go to streaming services only. But they said that that it has I said it backwards. There are more than that actually have cut the cord. But from an advertising perspective, they said there's only 20% of the advertising that has actually moved over to the streaming. And Roku and these streaming services, they make a lot of their money from the ad networks. So when they show a commercial, say on Comcast or DirecTV, that's not the same technology that they use to stream a commercial if you're watching a YouTube TV or Roku or Apple TV. That's an entirely different technology that gets those ad dollars. And so they're saying as more people continue to go there, and when the companies that want to advertise, he's saying that they're going to have to move their dollars to more streaming services because that's where the market is going. And he said that they only have a 20% penetration there, and he expects that side of the market to increase. And so I would definitely say listen to the conference calls of companies that you either own or are interested in, because you can learn tidbits there that, you may not know otherwise, because I wouldn't have known that, so it's just a FYI on that. So you can look here, so we just look at some of the other names. So you look at Tesla. Tesla is down. Tesla has been volatile. You can see here, hit a high back in January of 1,200. You down 40% to 856, right? Let's look at another good name. UPS, they hit a high February, but even coming off this high, it's actually not down. So it's only down 10%. That's tolerable for sure. Again, as compared, to some of the other things. Visa and MasterCard, we talked about that pullback. We saw this pullback here. You see, I had it marked in the chart. I should have bought some. I didn't. So you can see they're up off the lows from there to where we are now. So they're up 17% off the lows. Let's look at Wally World, Walmart. Walmart is actually in this trading range. So if you block this out here, you can say Walmart is in this box. So anywhere from 150 to 133 is where Walmart is. So that's traded, so what you say, what percentage is that? Up and down, talking about 10% up and down, right? So even if you was in Walmart, you wouldn't have lost that much money. Now let's compare that to a Zoom. We're actually using Zoom software here to do this call. So you can see Zoom has gotten killed. Zoom was a $589 stock. Now it's 126. Now my thing is, so Kathy Wood talks about Zoom and saying that, she believes that the demand for this is not gonna, it may taper off some, but it's not going back to pre-pandemic levels where a lot of people, won't have the need for Zoom, as the economy open up, because I think that we've gone through a shift, and I tend to agree with her. I think we've gone through a shift that some things are probably going to be remote from now on, to some capacity, and that there's going to be a need for remote telecom services such as Zoom. So, and I'll show two more. Square has absolutely been getting killed. High at here 270. Square is $97 right now, getting killed. But this is one that I'm in. I just been adding to it as it's going down. That might prove to be the bad move, but that's what I've been doing. I think that Square is going to be all right, because so again, we know that cash is being digitized, taken away, that you're going to have less and less physical dollars in your pocket. And so these digital wallets, companies, or payment apps, they're only going to increase more and more as time goes on. Plus their business apps that Square has. So like, a lot of beauty shops and barbers and things and contractors, they use Square in order to process payments from the clients. And I think they even have terminals where you can, pay for things at small merchants and stuff like that. So I think Square is going to be all right. That's my long-term thesis, but right now they're getting killed. And kind of on that is a company called Shopify. Shopify is a Canadian e-commerce company. You can see here, this is probably one of the most brutal charts around. You're looking at 1,700 down to, wrong tool, 1,700 down to 656. So Square is getting killed. So down 63%. All right. So
another killer is DraftKings, but I guess I'm looking at when to get in on that. I guess I don't I think people are gonna get back to gambling, but that could be me, even though I know that there's a lot of competition now with the online gambling. So I'm debating on that puppy.
Yeah, they definitely have been getting killed. and I think one of the things too is with DraftKings, and I don't follow DraftKings, but let me just see something. And we don't have that much data, so that's what. Let me see. It's February. It's March. Okay, earnings, they dropped off. I'm trying to look. So really what I'm really looking for is, so, we just had the Super Bowl. So football is going away. So that's going to take away a lot of opportunities to bet in some things like, so football season. I know football is a huge betting deal. But baseball is starting up. I don't know how many people play fantasy sports on baseball. I think football is just a bigger catalyst. Let's see. But you got the NBA, hockey. So just trying to see if we can see if there's drop-offs after February. A little bit. And then to this February. Yeah. I don't see a clear pattern around the end of football season. That's what I was looking for. But yeah, they've been getting killed. And again, they're probably getting killed more just because of the drop off from the rotation of the high value stocks into for the high growth stocks into value. So they got caught in that downtrend. So if you look at their PE, they don't even have a PE ratio. So they're still losing money. They haven't reached profitability yet. So they got killed as a result of that.
Mike, take a look at Philip Morris.
Okay. Philip Morris. What's that ticker?
PM.
Thank you. Yeah, tobacco company. Wow. Hey, it's a commodity. It's true to form, D. Good call.
Yeah, that was a guy was saying no matter how high the interest rates go, inflation gets, people addicted to tobacco gonna buy cigarettes.
You know what? You bring up a good point. Let me see another thing. Let's see how Starbucks is doing. Because you say that same thing when you say cigarettes. I think coffee, but this is actually going the other way.
The inflation is getting this one.
Yeah, inflation. So that's actually hurting them from a cost perspective. But that's weird though, because you would have. Okay. Yeah, I guess you can say that. Go ahead, Milt. Go ahead.
I tried Mo, MO, and KO.
Okay. Is this a cigarette maker as well?
Yes.
What brands do they do? Do you know?
No, I really don't follow them. I just know them.
Okay. Yeah, I used to know. I can't remember. Okay, but yeah. So you can see here, this, man, shucks, this is actually the trade. If you'd have sold all your small caps and bought this, because we were saying right at November 8th. So you can see here, it bottomed on the 30th. And, what's that percentage run? I'm going to add this to my watch list. Up 24%. And let me add that to the watch list here. Yeah, add that one then, that Philip Morris. Okay. Yep. So it's good to kind of know what stocks, and when this rotation happens based upon this environment, it helps to know where you can see where some areas are pulling back and then where that money, because overall what happens is that there's a bunch of money out there, right? And depending upon the environments, like we've kind of talked about, this money rotates from sector to sector, depending upon what's going on, with the interest rates, with geopolitical issues, just with earnings, so, and even regulatory things, they can rotate. And so we're talking about these commodities. Commodities are in favor right now, and you can actually see it in these charts. And I'll finish up with, let's see what these banks and stuff are doing. JP Morgan, they pulled back and kind of middle of the road. Let's look at Citigroup. Kind of pulled back as well. Bank of America, they pulled back as well. Now, for these banks, I wonder what's going to happen when they actually institute that either quarter point or that 50 basis point move when the Fed actually announces that in March. So it's going to be interesting to see how the banks do off of that. So, all right. Any other comments? I mean, it could be portfolio comments, trading questions. Anything.
I got a question.
Yes, ma'am.
So my mom just happened to be listening, and she asked me to check out Starbucks.
Okay. Starbucks. Yeah, we just looked at that chart a second ago. They've been getting killed here. So one of the things is that, so Starbucks has to buy the coffee beans. Coffee beans themselves, I don't know what the coffee commodity, let me see. Yeah, they don't have commodities on here, but let's see. Okay, here's coffee. Let's see if I can find it here. So you can see the price of coffee is increasing tremendously, right? So as a result of that, Starbucks either has to do one or two things. Either they're going to eat this higher coffee price, or, well, they can do three things actually. So the price of coffee is increasing. So just generically, they're going to have to pay more for that with the caveat. And so either they're going to have to raise their prices and, to account for the increase in coffee, or they won't raise the prices and just eat that loss. And one way that they can do that is with go back to Starbucks. So we've talked a little bit about options. So I'll just try to make it, so with options, what you can do is you can do stuff that's called a hedge. So just like we were just looking at the coffee price for Starbucks. So what Starbucks can do is they can go out on the market and they can go to the coffee futures and they can hedge their price. What that means is they can say, hey, we know coffee, let's say they did this a couple of years ago. Coffee was $1 and something, whatever that previous chart showed. And they say, hey, we want to lock in the price of coffee at $1 and say $1.50 versus $2.30, right? They could lock those prices in by buying hedges. And what they can do is secure their coffee supplies, say for the next year and a half, and lock them in at $1.50 by using options and futures in order to do that. And so what they may be able to do in the short term instance is that even though the price of coffee is going up, what they can do is lock those prices in such that they can have, they don't have to feel the brunt of that coffee increase immediately, and they can stave it out some. So depending upon how many hedges they put in place in order to do that. But also here, let's look at what their PE is. So they could have been, just a higher PE at the point when they're at 96. But even so, when you look at this, that looks like that was a pretty big pullback. But from a percentage basis, it actually wasn't that bad. So, 20% in comparison to some of the other things, 20% pullback is not too bad on that. So,
hey, Mike, let's chart this out. It's looking a little interesting.
Say that once again, Milton. Couldn't make that out.
Can we do a chart on this? This is looking a little interesting here.
Yeah. All right. So just look at our peaks. Peak here, peak here, peak here. These three. So I'm gonna just take those because it corresponds to those there. You can see a bottoms in this general area. I'll take those there. And so you can see the stair step, one here, and one here. I'll stair step all three of those. And you can see this one kind of corresponds with the top of this point here. And so I'll draw that one, and then I'll draw kind of where we are. All right. So here we go. So you can see you got so we're definitely in this range. Back here from this 97 down to this 92. And you got increased volume here as well. in this general area. So you higher volumes into a previous support area from 99 to 92. And so 99 is the next resistance above you. Above that is 102. Above that is 108. And let's just look at a longer term view on that. Let's see what else we're looking at. Yep. And you can say probably here at 83 and then again here at 77. So, yep. So that's Starbucks. Now, one thing here is building a nice base, really nice base sideways here. When you see something like this on a chart, this starts to tell you that momentarily the selling pressure has stopped and you got buyers and sellers in this area trying to figure out who's the strongest. And pretty much when you have it going sideways, it pretty much tells you that it's neutral from this range of 98 to 93. You got equal number of buyers and probably equal number of sellers at this area. Now, if you break below this 92, that means the sellers have won, and then you'll be looking to try to establish a new base, somewhere below that point. But as of now, you're just trading sideways on that. So building a base or consolidation is something that you want to chart, because a lot of times if this happens, I can't predict what will happen in the future, but this might be a point where if they can hold this 92 and go sideways, and the longer this goes sideways, the stronger this base becomes for either a move higher. Now, just think of it almost like when you take a spring, put a spring between both your fingers and you kind of squeeze it together. This is compression here. And if you move your fingers, how the spring will get out and it'll just kind of flip out of your hand with a lot of energy. That can happen here either to the upside or to the downside. But as of right now, it's just building tension in this area. All right. So that's about all that I have. Any other questions? Again, trading, orders, anything, account.
Not a question, Mike, but I guess just in your conversation here with Starbucks, I guess that's what I'm starting to wonder right now is, are we rolling over from that switch to the values back into the growth? So like, have we kind of topped out on that? And are we going to now start looking at, or rather, should I now start looking at, okay, jumping in and doing my little nibbles at purchasing?
Great question. And this is how I'll answer it. So if you look here, I would take so this is what type of stocks are you looking at for that brand? Because I want to make sure I look at the right indice. So you're gonna be doing more tech stuff, you thinking?
Yeah.
Okay.
Yeah, that's what I'm debating on.
Okay, so more tech. So what I would look
curious what, like, for example, like I noticed AMD did good yesterday where NVIDIA didn't. And so still, yeah, so I'm just eyeballing those guys to see, okay, I'm about ready to get off the sideline, to be honest with you.
Okay. What I would do is do this. So if you take an AMD, for instance, draw this trend line and look to get a break above that. Now, I guess my first order of business, so you can look at individual names and you can chart them and draw your trend lines, right? And they'll give you a signal. But for me, I'm really waiting till it's really not a chart thing. It's really more of I'm waiting on the Fed to announce that first rate hike. And I want to see what the market does after that. That to me, that's the biggest boogeyman around right now. And once we get that out of the way and the market digest it, I think we should be able to have a little bit better clarity. So that's the first point. Second point is also just listening and figuring out what's happening with unemployment, with inflation, with CPI numbers. I think those things, because that's the information that the Fed is going to use in order to make their decision about further rate increases. And so if they say that, hey, because a lot of times they'll come out with these numbers and they may revise them, a month or two later and say, oh, that number that we had in January, we noticed that it really wasn't that high because it didn't follow through. So therefore, where we said inflation was the highest been in 40 years, it's really not as bad as, we thought it was. And so if they come out with some complimentary news, kind of like that, it may bode well. But I would definitely keep an eye on that rate hike, and then the follow up to that, and to see how the market digests it. And if you look at so this is the trend line down on the Nasdaq. All right. If we draw the same on the Russell, you can see the Russell's already been, in their thing. And so you can see the Russell's actually starting to consolidate sideways here. So let me get the right tool. So it pretty much consolidated sideways. So if we could just, let's assume we can get this to just do this. If we can just continue to get that to go sideways and not much lower, and get that economic news, this is going to bode well to say, hey, it might be a time to start nibbling again, like you said. So those are the things that I would look at. So for Nasdaq, I'm looking for a trend line break here after that Fed move. So if I get a trend line break above that, and on a Russell, if I can just go sideways, or even see that it continues to break out on the top end of this, and you start to return that, and you'll see it show up in these indices if the risk trade is starting to go back on, and so you'll see it in the indices, and then you can look particularly at some of these things that are down huge. So like take a Chewy is down, Chewy is down 55%, right? So if you see that changes, let me give you another. If you look at those ARKs, these mutual funds, if you see these start to turn over, right? So these are some of the tea leaves that you can start to watch and see if they start to break. So if I draw this here, this downtrend, and if I can get a confirmation to the right here, that's what I'm gonna start to look for. But you can even see here that they're starting to build a base. So the beginnings of it might be starting already. We just don't have confirmation yet. And that's what you want to wait on. Because what you can do is you can possibly get a head fake. So even here, let's just look at this one in particular. So, and I'm gonna just draw them out. So when we first got down here, we got this little bounce, right? Got that little bounce. You thought you was gonna break out, then they slammed the door on you. You back down. You got it again. It came back up. You thought you was gonna again break out, and you can see here, slam the door. It's back down. You see what I mean? So it's just going. But the thing that is encouraging about this is that this is staying in range. Now, if it breaks below here, then all bets are off. That consolidation here, it didn't hold. If you break below this 27, and that same concept again is kind of where we are here on this Russell. And then if you look at the S&P, you can see here S&P is pretty much the same way. So what we're looking for is getting that economic news, and then where we can break above this and start a new trend to the upside. So that's what I'll be looking for. Did that answer your question?
Nope, that makes sense.
Okay. Let's see. Barry, you got anything? Hadn't heard from you today. I know you might be at work, so if you can't talk, that's fine. All right. Anybody else? Anybody got any words or wisdoms before we depart?
Hey, Mike, I am at work. Yeah. What sectors you said look at?
I was just saying in terms of, so Brenda asked a question. She was saying, when do you think that the rotation from the value stocks back into the growth stocks may start? And my answer is I want to wait until the Fed come up with when they finally announce the interest rate increase. Once that's in place, and then when you start to see the Russell, the S&P, and the Nasdaq break out of these current downtrends or sideways trends that they're in, that would be the confirmation that I'm looking for. But I'm waiting on that interest rate move first. Now, if you brave, Brenda, you can start nibbling.
Yeah, that's pretty much what I'm gonna start doing, to be honest with you.
Yeah. Anything that you're looking at specifically? What's your top 3 names?
Well, I do have the banks already, but I was debating on what you guys had talked about with Sophie, diving in on that. But I also have like what you had mentioned, some of your squares and stuff like that. So I might build on some of those kill points that we're sitting at.
Yeah. So SoFi here, you can see they're definitely building this base, right? And I've got this downtrend, and so it's just kind of breaking the downtrend because of time, not because of necessarily starting a new uptrend here. So if I pull this out, so this is SoFi here, and actually you can see here we're back to this range of when they IPO'd, and so if it can hold this $10 range, that's encouraging. And if it just continues to go sideways, and let me change this angle on this downtrend. So if I extend this out right there, so still looking for a confirmation, a break above this box or a break above the trend line to the right here, or, is where you want to start. But again, it's still under the guise of having that other piece of information kind of in place, because what could happen is we could get a momentary bounce off of that interest rate raise, and only for them to slam the door and we back down to these areas again. So we've just, so the last month, we've just been chopping up and down. And if you take that, we go back to the indices just as a larger thing. You can see here, let me move this out of the way. You can just see here, we've just been chopping up and down. And this is just the market doesn't have a clear direction to the upside or downside. And this is Nasdaq. But once we get a clear direction, and again, this may be, and here's the thing, sometimes it just really depends on your appetite. If, like Brenda says, she wants to start nibbling a little bit on some names, and I'm just looking at the Nasdaq particularly, and you can start nibbling. If you're right, you're gonna be rewarded for being early. If you're wrong and we get down below, then trying to pick a turn before the turn is actually confirmed, you pay the price for guessing. And that's just the risk that you have to take. So if you want to wait on it, then you wait until you get confirmation. But a lot of times when you wait for the confirmation, you won't get the best prices on the low side, because confirmation will actually have to happen at this level. And let's say it broke out to this point. If you're looking for confirmation, you won't get confirmation until this 14,490 here. Whereas if you were nibbling, you could be nibbling down here at this 13,893 level, right? So that's the difference. Now, waiting for confirmation, let's say you didn't take this here and it broke down lower to this 1200 range. If you were picking up a little bit, let's say you picked up a little bit in this area and you picked up a little bit in this area, but if it continued to go lower and it broke down and it broke down to this area, by you not waiting for confirmation, now you've got more losses at that point, right? Whereas if you waited for the confirmation and you didn't get it, all you would do is just extend the trend line down and it can save you. So, but again, that's the difference between, being a pioneer or, waiting for the signal. And that's just personal preference on, again, if your demeanor says that you can stomach lower lows, and if you divide those up, let's say, for instance, if you had $1,000 and you want to start nibbling, and let's just say this is a stock as opposed to being an index. Say I'm gonna pick it up into 4 different trades at $250 a piece. Okay, 250 there, 250 there. If it breaks down, then you can pick up another 250 somewhere down in this box if it goes that low. So you don't have to make your buying decision all at once. Now, where that sucks is, let's say, since we're being hypothetical here, let's say we take that out, take this away, move that back, move this back. Let's say that's it. And let's say we get an uptrend that starts. We get the confirmation. Now the stock goes back up in here. Now you're going to look like a genius picking these 2 points. But then you may say, well, man, I should have put that $4,000 to work as opposed to only putting $500 to work. It's always a guess and a gamble, and I won't say a gamble. It's a gamble in terms of how much you allocate at a certain point, because you don't know if you're going to be right or not. And so that way you just got to be able to, readjust depending upon, sometimes your thesis is going to work out and you're going to, again, look like a genius. Other times it's not, and it's going to go against you, and you're going to buy higher than what you wanted to buy, and you're going to be down in this area. So it just really depends. But again, your personal, your personality, your demeanor about how you trade and how you deal with stress and risk and value, those things come into play. So that's all I got, guys. If you any parting questions before we leave?
Back on Sophie.
Yes, sir.
I just want to make sure, y'all may have already talked about this. I dropped off.
Mm-hmm.
But March 1st, a very big event is coming up to earnings, and this could go really low in a hurry. You think it's low now? It can go a lot lower. What I'm going to do is probably put an option play on this.
Mm-hmm.
I'm not sure which one,
mm-hmm.
but I'm hearing things like 9, probably about around 14. So it could go down to 9, go up to 14.
Okay. Yeah, that's actually let me show something on that. So in options, they don't even have it up yet. I thought they would have had it priced, but in some options up here in this little area, you will see a little thing that sometimes when they get close to option, it'll say market maker move. It'll be right up under where it says 0.79. And I'm looking at the chart not the chart to the right, but on my phone where you see me here moving. So it'll have like a M and it'll say plus or minus, and it's usually like, I think, in gold. And so it's a market maker move. And what that shows is that based upon when earnings are coming out soon, they will say, hey, a plus or minus to the upside and downside. And that's kind of what Milton said in terms of, and there's a way to compute it. I don't know how to do it, but I know that there's a way to compute it. But so he's saying 14 to, so the range is, he's saying 14 to 9. So it's saying after earnings, they're looking for a move. I'm sorry, get this to draw. Come on, why my thing not drawing? Yeah. So from 14 to 9, where the move can be anywhere from here to the upside and there on the bottom side. So that's where the market maker move, if that corresponds to that figure, but from 14 to 9. And so with options, as you're trading options, there are certain options that you can buy based upon that, where you don't necessarily have to pick a direction. You can pick both directions at the same time. And whichever one wins, provided that the magnitude of the move is big enough, you can there's a way to profit off of that. So, but but SoFi, it's interesting. I know they got a lot of press with them having a Super Bowl in the SoFi Stadium. So that's the same SoFi. So, and they're in this space again with they started out with student loan or refinancing, but they've branched off into crypto, stocks. It's a digital wallet. Think of it like a Square or PayPal type thing. So they're really trying to make inroads into that. So again, that goes again back to the thing we were talking about before, the digitalization of the dollar, where you can just send cash through an app, and you're not handing physical dollar bills back and forth. So, any other thing? Anybody else?
I just want to also throw one more stock out there for the people who are looking for early nibbles, which is not me, by the way. I'm more than content to wait. Let's see, it's UPST.
UPST?
Yes.
Oh, yeah, Upstart. Yeah.
Oh, yeah.
Yeah, actually, I traded that yesterday.
Smart man.
Well, it was just an intraday trade I saw because the market was rolling over. But yeah, so this stock I've gotten killed in, but I've been trying to fight my way back just by selling and buying back. And so let me move this out of the way. Selling and fighting back in this, but this company came out with earnings. Let me make this a little bit bigger. They came out with earnings a few days ago, and they did pretty good. So you can see here, they going into earnings report 109. They reported earnings. It got up to 137. So I was actually in this, and it got up to 137, 147, and it hit 157. So I put in a trailing stop, and I think I got stopped out at 140. 149, somewhere around in there. And so I was out initially, and then I saw yesterday, to show you all this. So yesterday's range was pretty crazy. So it opened yesterday at 139, and it dropped all the way down to 126. And I think I caught a trade or two from the 128 and some change to like 131. And I think I traded it twice. So, but that was just a trade. But overall, in terms of the revenues on here was really good. So you can see here, they were estimated to have a 51 cent EPS number, which just means earnings per share, and they were actually reported 89 cents. So that was a surprise to upside. So when you get a surprise either to the upside or the downside, and depending upon the magnitude of the surprise, so this was 75% better than what they thought. So therefore, you see it reflected in a gap. So you got a gap to the upside. However, and I'm gonna show another example after this. You can see, even though they got the gap to the upside, you can see the next 2 days it started to pull back. So where you hit this high of 160, you pull back to 130. So just because you get a bump in earnings, sometimes it can't sustain that magnitude of that jump, and it pulls back. So if you're trading it, you have to be quick in order to take your profits and lock some of those in. And so when I was in here, I didn't want to give up all of that. So I just locked some in before I started trading it. Now I'll show you another example where I didn't do that and got killed. Let's see, Google. So Google came out with earnings here, pretty much same thing, huge up. So one thing that I jumped, and this is where I jumped the gun on this trade. I should have waited, but I didn't. And just what it was. Google came out with earnings. Earnings were great, but they also announced a 20-for-1 stock split that's supposed to take place in July. So I was like, hey, I've been looking at Google for a while, didn't squeeze the trigger. So I ended up buying, but I've been buying too early. And you can just see it dripped all the way back. So much so, they've lost all of that appreciation from that earnings and even back below that. So if you look at this here, this was a 9% move to the upside, but you can see that they've actually gone lower. So they're 4% lower than where they were before earnings. So that's an instance where you can be early, and by being early, it can come back to bite you. So that's the other side of being early. That's the bad case. So it happens. So the only thing I've been doing is just trying to add a little bit lower in order to get a better cost basis, because I believe in the stock long term. My goal is to wait again, and kind of like the same thing, going back to the question Brenda talked about, is that this is the PE on it is reasonable, so it's still value, but they just thought it got overpriced at this 3,000 level and pulled it back. But if they get as the climate kind of works itself out, I believe that they're going to continue to return, that the stock price is going to adjust and they're going to be all right. So, but I could be wrong and it might go lower, so that's just the responsibility you have to take when you take a position. Either you readjust, your position, you sell it, you get out, or you have conviction, you hold to it. If you have more conviction, you buy it if it goes lower. So, there's just decisions as investors and traders that you have to make and take responsibility for. But this is just a case where earnings, start to pull back. And so having done this in Google, I didn't want to repeat the same thing that happened to me I'm sorry, I'm trying to get this over. I didn't want this to repeat on me again. What happened in UPST that I did in Google. So that was a reason why I say, hey, I wasn't going to let all those gains go back. So I put a stop loss in and it triggered. So, and that's one thing about this. If you do something and you see it go contrary to what you have done, then when you get another opportunity and you see that same thing kind of play itself out, then you say, okay, use that experience from something that you've just witnessed or gone through. And you say, okay, let me not repeat that mistake again. So that Google loss helped me not to take a loss here, a bad loss, and to lock in some of these gains based on the same thing, because I was in at earnings. I got an earnings bump. I bought, didn't lock it in or didn't put a stop loss in. And therefore I ended up going lower. So whereas I got out in this area on that Google trade, I held too much longer, where I should have been out somewhere in this 29 area, but now we're down to 26. So use your experiences as you go through this stuff to learn from your mistakes and just, incorporate that and say, okay, I did that cost me. Let me learn from that. Let me do something different this time. So. Right. Well, as always, thank you all for your time. Really appreciate the participation. For those of you on the sidelines, just keep your ears and eyes out for that March move for the Fed, the announcement. In the meantime, just keep watching. And I would say, go through your charts still, even though you're not going to buy anything, still go through your charts and start putting a list together mentally, or either write it down on paper of things that you want to start nibbling at, provided that the market takes a turn in your favor. Right. So given that, I again appreciate it.